this video, we will be discussing about the definition of financial distress, categories of financial distress, causes and signs, stages, consequences, solutions of financial distress. We will also be discussing about the effect of COVID-19 on the company and real cases of company that faces financial distress. What is financial distress? A corporation is said to be in corporate financial distress if it's having serious problems paying its debt and cannot afford to continue operating. It usually happens when a business cannot make enough money from its activities to satisfy its debts and other financial obligations, much alone its operating costs. Financial distress is generally due to high fixed costs, a large degree of illiquid assets, or revenue sensitive to economic downturns.
So moving on, I'm going to proceed with the categories of financial distress. It can be categorized into three, which are operational, market, and reputational. So, operational distress refers to a challenge a company faces in running its daily activities effectively. These issues can include in declining sales and inventory management issues. So, declining sales happen when a company experiences a drop in sales revenue over time, which may struggle to generate enough income to cover its expenses. Same goes to the poor management of inventory, which can lead to excess stock or shortage, impacting cash flow and tying up capital. Next, reputational distress. It occurs when a company's brand reputation is damaged due to a negative publicity, scandals, or customer dissatisfaction. This can impact consumer trust, sales events, investor confidence, and relationship with stakeholders. Moreover, suppliers, business partners, and other stakeholders may reconsider their relationship with the company if their reputation is damaged. This can affect supply chain operation, collaboration, and a strategic alliance essential for business continuity and growth.
What causes financial distress in a company? Let's take a look one by one. First is poor management decisions. Strategy errors such as entering into unprofitable markets, overestimating demand for a product, or failing to respond to competitive threats can quickly reduce a company resource. Operational mistakes such as inefficient production process, poor supply chain management, or inadequate waste management practice further increase financial problems. When management fails to make informed, timely, and strategic decisions, the company may struggle to generate sufficient revenue, control costs, and maintain profitability, leading to financial distress. Next is extreme debt. Companies that take on too much debt may find themselves overwhelmed by interest payments and principal repayments, particularly if revenue streams are inconsistent. High leverage increases the financial burden, reducing the flexibility to invest in critical areas such as research and development, marketing, and employee training. Furthermore, in times of economic downturn or business underperformance, highly leveraged companies face a higher risk of defaulting on their obligations, leading to bankruptcy or forced restructuring. Besides that, economic downturns can have a deep impact on corporate financial distress. During period of economic contraction, consumer spending decrease, leading to reduced revenue for business. Companies may face challenges such as declining asset values, increased competition for a shrinking customer base, and disruption in the supply chain. These external pressures can severely strain a company's finance, especially if it lacks the toughness to withstand economic shocks. Lastly, operational inefficiencies. Inefficient operations often result in higher costs and lower productivity, which undermine profit margins. For example, a company with outdated technology or poorly trained staff may experience frequent production delays, higher error rate, and increased waste, all of which contribute to financial loss. Operational inefficiencies can accumulate, leading to significant financial strain and distress.
Corporate financial distress often signals deeper issue within an organization that, if unaddressed, can lead to insolvency or bankruptcy. So here are some key signs of financial distress. The first sign is delays in payment, in which delays in paying bills, electric bills, accounting invoices, or any other regular payments are among the earliest indicators of financial distress. Second, decreasing cash flow. A drop in sales may result in insufficient cash flow for the company because there could not be enough money to pay its operational costs. If appropriate action is not done immediately and fixed by increasing sales or cutting expenses, this lack of available funds may lead to issues later on. Third, increase in debt. If long-term debt or existing loan balance rise, it may be a sign of unstable finance, as too much money has been borrowed recently, or if other loans have not been paid off, which could lead to more financial difficulties in the future. Fourth, low profit margin. This occurs when a company's revenue decline while its expenses remain constant. Eventually, this causes the profit margin to drop quickly, causing more serious cash flow problems. Furthermore, having a high amount of inventory unsold or neglected has certain disadvantages, in which reducing the inventory turnover ratio. This shows poor inventory management and inefficiency in selling stock. Lastly, lower creditworthiness with lenders, suppliers, and investors. Lower creditworthiness means a business is seen as less reliable in repaying its debts, in which, when a company's financial health weakens, its creditworthiness decreases, making it harder and more expensive to get financial support. This is because lenders, suppliers, and investors start doubting the business' ability to repay loans, pay for goods, or provide good returns on investment.
There are 4 stages of financial distress. The first stage is warning signs. There are several warning signs in financial distress. First is when the company faces a decline in profitability. Another sign is when debt level of the company keeps increasing instead of decreasing. The third warning sign is delayed payment to suppliers. The action by the company can have an impact on the supply company, as the supplier may not want to send supplies. During this stage, management may implement cost-cutting measures, initiate strategic reviews, or seek external financial advice to address these warning signs and prevent further deterioration. The next stage is initial crisis. This happens when the business starts to fall behind on payments or needs emergency funding to meet urgent needs. The company may start missing payments to creditors, suppliers, or lenders due to cash flow shortage or liquidity constraints. To alleviate these immediate financial pressures, it might secure emergency financing through short-term loans, credit lines, or bridge financing. Additionally, leadership may undergo changes as stakeholders demand accountability or seek new expertise to navigate the crisis. This phase often requires decisive action to stabilize operation and prevent a further downward spiral. Companies may prioritize cash flow management, negotiate with creditors for payment extensions, or explore asset sales to generate liquidity. The third stage is insolvency, the point at which a business can no longer afford its obligation when they become due and may file for bankruptcy. At this critical stage, the company is unable to meet its financial obligation as they become due, leading to default on loans, missed payroll, and potential legal actions from creditors. In Insolvency may prompt the initiation of bankruptcy proceedings such as Chapter 11 reorganization or Chapter 7 liquidation in the United States, or equivalent procedures in other jurisdictions. Additionally, the company faces heightened scrutiny from regulators, creditors, and stakeholders regarding its financial practices and compliance. Insolvency represents a severe crisis point where comprehensive restructuring or liquidation becomes necessary to resolve debts and liabilities. The focus shifts to maximizing value for creditors and stakeholders through orderly restructuring or asset sales. The last stage is restructuring or recovery. In this stage, company may want to sell their assets, renegotiate debt, or restructure the business finance in order to stabilize its finance. Non-core assets may be sold to raise capital and improve liquidity, helping to repay creditors or fund ongoing operations. Management focuses on enhancing operational efficiency, optimizing supply chains, and realigning business strategies to restore profitability. Additionally, communication and transparency with stakeholders, including employees, creditors, investors, and customers, become crucial to rebuilding trust and support. This stage involved significant efforts to rehabilitate the company's financial health and position it for sustainable growth. Successful restructuring may involve sacrifices from various stakeholders, but aims to preserve the core business and maximize long-term value. Throughout these stages, companies may seek professional advice from financial advisors, legal experts, and turnaround specialists to navigate the complexities of financial distress effectively. The goal is to emerge stronger from the crisis with a more resilient financial structure and renewed prospect for future success.
So moving on to the consequences. So financial distress in a corporation can have several significant consequences on employees. They can reduce the compensation and benefit of employees when a company often needs to cut costs like salary, reduce bonuses, suspend benefit due to the need to improve its financial stability and liquidity. This measure can directly impact employees' financial situation and quality of life. Employees may feel undervalued and demotivated if their compensation and benefit are reduced. This might not put in the same level of effort or may be distracted by their financial concern. Thus, the overall workplace culture can suffer, leading to a more toxic or disengagement environment, which can further exacerbate productivity and moral issues. Next, a company in financial distress also may experience disruption in their day-to-day operations. Financial distress often leads to cash flow constraint, making it difficult for the company to pay supplier and vendor on time. So this can result in delayed shipment of raw materials or component needs for production, thereby disrupting manufacturing schedules and causing operational delays. Furthermore, the companies may struggle to pay supplier on time or in full due to cash flow shortage as well. As a result, this can damage the customer perception of the brand and lead to negative reviews, because customers may lose their confidence in a financial distress company because they fear the company may not be able to fulfill orders or provide valuable services, or offer ongoing support. This can lead to a loss of business to more financially stable competitors. Customers may question whether the company will continue to invest in the innovation or an improvement. Financial distress can signal to customer that the company might lack the resource to stay competitive and offer new, improved products or services.
Now, let's take a look at the solution of financial distress. One of the most immediate solutions for companies experiencing financial distress is to restructure debt. Debt restructuring involves negotiating with creditors to modify the terms of debt agreements, which can provide much needed relief. This may include extending repayment periods, reducing interest rate, or converting debt into equity. By restructuring debt, a company can lower its debt servicing costs, improving cash flow and reducing financial pressure. Other than that, enhancing operational efficiency. To improve efficiency, companies can conduct a true review of their operations to identify areas of waste, redundancies, and bottlenecks. Implementing lean management techniques, investing in modern technology, and optimizing supply chain process are effective ways to reduce costs and increase productivity. For example, automating repetitive tasks can save time and reduce labor costs, while better inventory management can minimize holding costs and reduce the risk of stock out or overcosts. Next, diversifying and innovating revenue streams. By diversifying its offering and exploring new markets, a company can spread its risk and create additional revenue streams. Innovation plays a crucial role in this process, allowing companies to develop new product or service that meet emerging customer needs and open up new market opportunities. By expanding their revenue base and continuously innovating, companies can strengthen their financial position and reduce the likelihood of future distress.
Here's some effects of COVID-19 on financial distress. The first one is revenue decline. Many businesses experience sharp drops in revenue as a result of the abrupt halt in the economic activity. Business found it difficult to pay debt, maintain liquidity, and fund operating expenses while revenue was decreased. Second, increased debt levels. In order to meet their short-term cash flow needs, business had to borrow money, which increased their debt loads. This increasing leverage decreased future flexibility and raised financial risk. Third, operational disruption. Lockdown and supply chain disruption forced many businesses to scale down operation. Firms with high fixed costs such as rent, lease, and salaries face particular difficulties in managing ongoing expenses without sufficient revenue. For example, Marriott International faced severe operational disruption as occupancy rates dropped. The company had to fall off thousands of employees and cut costs significantly. And lastly, bankruptcies and restructuring. The pandemic accelerated bankruptcies and restructuring, especially for companies already struggling with pre-existing financial issues. Many firms filed for bankruptcy protection or restructured their operation to survive. For instance, JCPenney, a long-standing retail giant, filed for Chapter 11 bankruptcy due to the combination declining sales and pandemic-related store closures.
One of the companies that faced financial distress is Toys R Us. Toys R Us is an American toy, clothing, and baby product retailer owned by True Kids, doing business as True Kids Brands and various others. Toys R Us, one of the world's largest toy store chains, filed for Chapter 11 bankruptcy protection due to a heavy debt load of over $5 billion and intense competition from online retailers like Amazon and brick-and-mortar stores like Walmart. The company's financial troubles stem from a leverage buyout in 2005 by private equity firms KKR and Bain Capital, along with Vornado Realty Trust, which left it burdened with debt. Facing a $400 million debt payment in 2018 and depleting cash reserve, Toys R Us hired advisors to develop a restructuring plan. Despite the bankruptcy, the company secured $3 billion in financing from JP Morgan Chase and other lenders to continue operation and invest in long-term growth. All 1,600 stores worldwide, including Toys R Us and Babies R Us locations, remain open. The company aimed to overcome financial constraints and revitalize its brand.
So another real case that can be related to financial distress, we can take example from AirAsia's company. In 2020, AirAsia faced significant financial distress primarily due to the COVID-19 pandemic. The company reported net loss of RM 803.8 million for the second quarter of 2020. Further, AirAsia's Berhad laid off more than 300 employees to pay down its operation following the difficult situation faced. The layoff, which was said to have been announced by CEO Riyad Asmai during an internal briefing session, is expected to involve 411 of 1900 cabin crew members, 170 pilots, and 50 engineers. This layoff are part of AirAsia's effort to downsize operation and reduce costs in response to the steep decline in travel demand caused by the pandemic. The airline implements salary reduction across the board, with senior management taking substantial pay cuts to help manage the financial strain. So the employees affected by layoff have been received formal notification outlining the termination of their employment. These include details of severance package, final pay, benefit continuation, and other entitlements. Secondly, AirAsia implements extensive cost-cutting measures, including reducing its flight schedule significantly in response to reduced passenger demand. This allowed the airline to consolidate flights, optimize aircraft utilization, and reduce operating expenses related to fuel, crew, and maintenance. Due to competitive positioning has impacted AirAsia's ability to compete effectively with other airlines, especially when competitors maintain higher service standard or offer more attractive amenities. I think that's all for me.
Another company that faced financial problem is Revlon. In June 2022, a major player in the cosmetic industry, Revlon, filed for Chapter 11 bankruptcy due to a series of escalating challenges. In 1985, Ron Perelman bought Revlon through a leveraged buyout, which saddled the company with significant debt. Next, the COVID-19 pandemic made Revlon's financial issues worse by seriously disrupting the supply chain, where there is a 25 to 30% rise in production costs. Also, around 2021 and 2022, Revlon found it difficult to compete in the e-commerce market as popular companies increased their online presence and customer preferences shifted toward more well-known products. This made its competitive disadvantage even more severe, leading to Revlon declaring bankruptcy.
Airbnb is an online marketplace that enables people to find and rent lodging accommodation worldwide. During COVID-19 in 2020, Airbnb faced severe financial distress, leading to a 25% workforce reduction and rising $2 billion in equity and debt. The company's valuation dropped significantly, and it paused non-core activities and investment in hotels and luxury properties.